I can't tell you guys how many times traders have told me, don't use Martingale risk management. It's too risky. It's going to blow your account. It should only be used at a casino. I went against all the advice and decided to find a way to break apart the standard doubling up Martingale progression and utilize it in a way within my system that shows long-term profit. So you can see all of my accounts here, updated every 5 minutes. These are all public. You can check them out on your own time, and they're all in profit and showing really good equity and balance increases. So I want to break apart and show you guys Martingale and how I'm using it, because I think it's one of the most underutilized tools in the retail Forex market. Most traders just don't understand it and are told that it's a bad thing when it's actually one of the best, most important risk management tools that we have available to us. So a lot of you know that I'm an average in trader. So I use grid trading techniques, multi-order techniques to average into my positions into profit. And I use Martingale progression to help give me additional profit or to make my trading even safer. So how you guys know Martingale progression as typically 1, 2, 4, 8, 16, 32, and so on and so forth, where you're basically 2xing or you're doubling your next bet or trade to recover your previous losses. So trade 1 is a loss, trade 2 is a loss, 3 loss, 4 loss, 5 loss, and the sixth trade, if it's a win, it recovers all your previous losses and you come out with a small gain. So what if we break that down and we give ourselves a little bit more flexibility, where instead of we're going a doubling up, we're increasing it in this way. So we're breaking the standard progression, but the problem is if after trade 3, we're not recovering our losses anymore, and we're starting to come out with a loss at the end. So trade 1 is a loss, trade 2 is a loss, and if trade 3 is actually a win, then we're coming out with break even. Trade 4, we're coming out with a small loss, 5, 6, and so on and so forth. And it gets to the point where it breaks the mold and we're not profitable anymore. But if we use it in an average in situation where we're using grid or multi-order trading, so I'm going to give you an example here. Market goes up, comes down, pull back, down, pull back, down. Okay, and then it comes back, pulls out into where the market is at this point. Okay, so we're going to say order 1, 2, 3. I'll close out at this place or this area for an average in gain. So we have 3 trades. The first trade is a loss, second trade is a win, small win, and the third trade is a larger win. Okay, so we're going to say that first trade is a loss of $5. Second trade is a profit of $5. Third trade is a profit of $10. So that gives us a total of $10 total profit at this point. Okay, so that's average in trading using multiple orders. It's a really effective way of how I approach the market. Others are starting to incorporate it as well. And I think it's one of the best ways to trade in general because it gives you a lot more flexibility within your trades. You can also use more flexible stop losses based on equity, which is what I do in my trading. Okay, so what if we, and this is grid trading without progressive risk management. So that's with one lot size for each of these 3 orders. Okay, so what if we change the lot size after order 2? So we increase it to two lots, and then this one, trade 3, is 3 lots. So instead of it being a $5 profit when they all close out together, we're looking at plus $10 on this trade. This isn't plus $10. This is now plus $30. So instead of being at $10 profit, we're coming out now with 35 total profit on this entire sequence. Yes, it's become more risky, but if we do enough backtesting within our strategy and understand when its good places are within its history and it's bad, then we can kind of calculate what a good risk management is when it comes to using Martingale or progressive risk management. So we can kind of figure out, okay, so how many levels does our strategy go in backtesting history in the last 20 years? Did it go 3 levels? Did it go more than that? And if it did, then we can figure out where a good martingale progression is within that risk setting. And like I mentioned before, it doesn't have to be perfect. So what about the strengths and weaknesses of using the combination of average in trading with progressive or martingale risk management? The market is like a rubber band where it will stretch and retract or bounce back, stretch and bounce back. And that happens over and over again. So it's shaped like this, where it's stretching and then that snapback, pullback, stretch, pullback, stretch, pullback. And this has been the behavior of the markets for as long as we can remember, as long as there's data. And, a trend is formed in that way. But those pullbacks always happen. Sometimes they can be smaller, sometimes they can be bigger. So like a big stretch, small pullback, big stretch, larger pullback, big stretch, small pullback, small stretch, large pullback. So they're always happening in some way. And that pullback is what I look for in my trading, because it always happens. It's something that's more predictable. But you can develop your average in martingale based system on breakouts, on range trading, scalping, all this stuff. They all work. And you just need to find that pattern that's predictable or that's happened in the past. And where martingale comes into effect is always being able to figure out that I can profit even if it's a small pullback. I can profit if it's a large pullback. I can, the only time that I don't profit is if the pullback goes on or the stretch goes on too long and there's no pullback. That's when the risk comes in. And that's the weak part of this methodology. But the idea is that because traders have to take profit, because the market is always changing and things are changing the behavior within that trend, you're always going to have some type of pullback, and they'll happen. And that's why, if they don't happen or if they go on too long, you have a stop loss. That's when you break for taking a loss and you accept defeat. But if you can find a pattern where you have a lot of flexibility in, where it doesn't matter if it's a small pullback or a large pullback, and you develop your trading strategy so it's flexible within that, that's when the martingale risk progression really takes effect, because it gives you a lot more opportunity to be flexible based on the type of profitable pattern that you're targeting. So what that actually looks like in my settings. Okay, so if we break into the Ranger, which is an algorithm that has been developed and I've been using for the last 8 years, and it's still profitable. Just because I've been using it in this way, finding the best risk management that works within the strategy. So if you scroll down, you can see there's a lot of inputs. I want you guys to just focus on one or two of these. So lot size increase, multiply. And we're increasing our lot size by 1.5 times or 1.5x after every third trade. So that means that the fourth trade is going to increase its lot size. So what that looks like is you can actually even see it right here. So trade 1, 0.01 lots, 0.01 lots, 0.01 lots, 0.02 lots. So that allows us a lot more flexibility when that recovery happens. Do we decide that we're going to take more profit because we've increased the lot size on the fourth trade when it does come back into our favor? Or do we close out the trade earlier because that lot size makes up the difference faster than the 0.1 lots from the earlier trades? So it gives us more flexibility on taking profit. We can extend it, make more profit, or we can cut our trades sooner with less price movement in our favor, so we can come out and get rid of the trade earlier. So more flexibility within that. But we have to make sure that our lot size increase makes sense to how we're using our strategy. So in this case, I found that the best one was increasing by 1.5x after every third trade. And that worked best for the strategy when backtesting it all the way to 2006. So a lot of years of backtesting has showed me that this kind of martingale progression worked best with this type of strategy. Now, the Ranger also trades on the pound Canadian dollar as well. And in this one, I have the martingale progression of 0. And this is one of the few strategies that does not use any kind of martingale progression because it doesn't need it. It doesn't need to increase its lot size, or it's not necessary. it adds extra risk potentially to this particular strategy over the course of its backtesting history. Where I thought that the Martingale multiplying of 1.5x after every third trade wasn't the best fit for it. This is something that you guys need to test in your strategy. Backtest. Are you a manual trader? Find out where your strengths and weaknesses are within your strategy. What causes you to run into drawdown? When is your trading best? Would it benefit from a progressive risk management strategy that's not a standard double up? These are the kinds of questions that will help you in your trading and allow you to have more flexibility, to become more profitable, to become less risky as well. Martingale progression doesn't always have to add risk to your strategy. It can actually take it down if used in the correct ways. I hope this video has been helpful on your journey of becoming a profitable trader. Thanks so much for watching, guys. See you on the next one.